we got our margins done. Our next topic is the pricing. And I mentioned a little bit about the pricing just a second ago in how we set the price. That's not what we're looking at here when we're talking about the KPIs or the business metrics. What I'm looking at is what's called the price premium. Meaning that how much of the price can I add on to the regular parts, the regular pricing in the industry? So what is my price premium? How much can I charge more or less than a competitor for a similar product? So that one we would like to monitor in order to say, is this going up or is it going down? If it's going up, if we can charge a higher premium, it probably tells us something about how our market standing is compared to our competitors. Maybe our branding is working better, maybe our communication is working better. So price premium above or below market. Then we also have what we're looking at from a customer perspective. Percent good value. Because whatever our price is, doesn't really make a sense, to be honest. What makes a difference is what the customers think. If they think our product is good value, well, then they are more likely to buy it. And then that's what we're looking for. So percentage of our customers or people that we survey who think our product is good value are the ones that we are interested in. It might be an expensive product. Think about the iPhone, really expensive piece of hardware. But how come a lot of people buy it? Well, they must find it a good value. And also meaning that the value is not just tied up in the monetary pricing of things. It could be that the services around it, the design, the ambience that people associate with the product. Do remember one thing from the economics is something called elasticity. And no, it's not the rubber band that you play around with in the class. It means how much is the demand or sale going to change if we change our price. So if the sale is not going to change if we raise the price, well, we should probably raise the price and therefore get a better margin and get a business project. If we lower the price, how much are we going to sell extra? Again, that's our elasticity. You can, to some extent, get an idea about it if you, in a survey with potential customers, ask them what price that they would strike at or buy the product at. All right, next one, cost structure. The cost structure comes in two classic separate parts, well, at least from basic economics. It comes in our fixed costs and in our variable costs. You might have had it, but in this case, it's actually important that we remember it because our variable costs and our fixed costs has a big influence on how our business is running. Fixed cost, especially if you're a startup or a smaller company, is a very, very critical element. It's your rent. It could be maybe your employees, some of the salaries. It could be a number of other things that you always have to pay. Even if there is not a single box going out of the door of your business, if you're selling nothing at all, you still have to pay the fixed cost. Do remember, there is a small thing called time. And time is important when we talked about fixed versus variable cost, because in the long term, longest there is, every fixed cost becomes variable. You can fire your people, but they will need some time to, according to their contracts, where they will have some salaries, etc. You might end up selling your or returning your rent lease agreement, saying I'm not going to use these rooms anymore, and then it becomes a variable cost. But not in the variable cost from economic and what we are looking at it here. Variable cost is costs specifically tied to the product. And if we're having a small figure here, where we have our number of units sold and our variable costs, we will have a linear link between the two. So if I sell one more unit, I will have to pay X amount of dollars more. Variable costs, fixed costs. The other thing I'll talk about here in our cost structure is our marketing spend, because our marketing spend also comes in a variable and a fixed element. Fixed element is often what we will be terming as branding or market build. Our branding is to establish ourselves as a name. If you remember our top of mind metrics from the house, minds, and markets, we will need to be evaluated. We need to be in the pool to be even considered. A variation of that is our market build. That's the cost for our salespeople in the new market. Who is building up the market, building recognition, building branding. Those we will have to pay to build the market even before we get it. Our variable costs is then often what we try at least to do the digital spend, our AdWords and those kind of things. Because what we're interested in, we want to have our marketing spend in the variable version as big as possible, because there we tie it directly to sales. All right, that's it about our cost structure. Then let's look at the break-even and contribution margins. So when we're talking about these contribution margins, linked up here, and break-even sales levels as we're looking at in this one here, our contribution comes as a dollar or as a percentage, meaning how much does each product or product category or segment, customer segment, contribute in terms of dollar and in terms of percentage of business. Segments means we have different types of customers. We might have our good customers who come back all the time. They don't make a fuss. They make good dollars. But have we been giving them a big discount in the early days and therefore they're not giving us a percentage profitability? Well, then might be the time to let these customers go. Are we looking at customer segments, potential customer segments, which has a big value? But in our business, it's not going to fill up very much. Well, then we might not be interested in working with them. In the same way, when we evaluate our products, how much of turnover are they working on and how much profitability percentage is it giving, either on individual product or product categories. That also means that we can use this for grooming. Grooming our portfolio of services, customers, products, and product categories. We only want to keep the ones and service the ones which is giving us the right profit margins. Do be aware that there are products that are linked to each other. Let me give you an example. You could have a product which is not really giving that much dollar. It's your vacuum cleaner. But your spare parts is giving you a huge margin. Well, you cannot kill the vacuum cleaner and sell the spare parts. You need the product to sell the services. So you have these linkages within your product category or even in your segments. You might be selling at a loss for certain customers, but because they have a marketing value for you selling the next product to others who are willing to contribute with a high margin, therefore you will take them. All right. When do we do this? And especially when we're introducing products, that's where we get to the break-even points. And it's quite closely linked to these ones here because we need to have a certain amount of dollar spent because we have some fixed costs which need to be covered, and then we need to have a margin. So what we're looking at in terms of our break-even of sales is that, again, we have a number of units and we have a total cost. Our total costs is actually starting in the negative territory. Why is that? Well, you need to do some investment. You need to develop some things. So at a certain point, as you are selling more products, you will reach a point where your total cost, which is investment plus, minus investment minus variables cost plus sale or turnover. When you solve that in terms of number of units, you get your break-even point. All right, so that was the break-even. It was our contribution margins, segment, product category. Let's move on to our returns. So the returns on what? What we're looking at here is primarily the returns on our investment. And investment can be in multiple different categories. It could be your return on marketing. So how much business do I get out of every marketing dollar I spend? How much do I get out of every dollar I spend in a new machine? How much do I get out of every every dollar I spend on training my employees in terms of efficiency gains? These calculations are a cornerstone of what you're doing in your business. You want to do the investment calculations. And I don't want to calculate them for you. You can look up the formulas yourself. Well, maybe in the notes below. What I want you to think about is that whenever you do something, there is a cost associated. You need to recover that cost. You need to get a return on that. So whatever you do, you need to think about, okay, will this pay me back? If not, well, you should probably not do it. Else you need to change the scope of your investment. So return on invest is the number of dollars that you get out of doing stuff. Sometimes you need to be creative, but you remember it always needs to be linked directly to that investment. What we also have a special variation is what's called the MROI, the marketing return on invest. And the old saying goes that when you spend $100 on marketing, $50 is working, $50 is a waste. Problem is, we don't know which is which. So we need to spend the $100, even though we know that half of it is wasted. So our investment is only 50% working in the marketing return on invest. Digital marketing has an algorithm that it is better. Maybe it is, but it doesn't really seem like it. Studies have shown that we're still not getting the promised benefit from our digital marketing. We do see a lot more transparency in what is happening than we do when you put an ad in the newspaper. How many does actually see that in the newspaper, as opposed to how many does actually see the banner on the website. So that's what we're doing. The last one I wanted to touch upon in this small video is what we call the big one, the EVA. And it's our economic value add. And it's the big one in terms of our business metrics, because this is economic. So how much money, value we are adding based on our business. So what we will be looking at is the net operating profit less our cost of capital. Well, net operating profit makes sense. At the end of the day, how much is it that we're profiting? How much can we put into the bank account and say, hey, this is what we earned? Cost of capital is a little bit more tricky because it comes in two variations, or roughly two variations. It comes in what we have to pay to the bank in interest, and what we have to pay to our shareholders as dividend. Now you might say, hey, well, I have a startup company. I don't have shareholders. It's just me. Well, what are you being paid for your effort? The amount of hours that's your dividend. So the cost of capital is the dividend either to shareholders or to the owner of the company so that they can live, and the interest to the bank. The down payments for these ones here, not included. So our net operating profit less our cost of capital is our economic value add. That's actually what we are doing in our business from a business perspective. Thank you for watching this small video. Well, a little bit long though. See you in the next one.